Hello and welcome to Business Mind Investing. Today we will go through a case study of one of the biggest winners for Peter Lynch. We have covered Lynch in previous videos, so if you haven't watched this, I recommend you to check this out. Lynch claims that investing is both an art and a science, and well, I completely agree. I want to show you how those two combine in practice. Today we will study how and why Peter Lynch has chosen Fannie Mae as his pick and why it was a brilliant idea. Also, please note that we are talking about 1977 when he bought this stock for the first time, and it was far away from the tragedy that happened in 2008 real estate crisis. Full name of the company is Federal National Mortgage Association, and it was established by Franklin Delano Roosevelt in 1938. If you know a thing or two about history, New Deal was introduced as an answer to the ongoing crisis in the 1930s. It was a social economic package of reforms with the aim of which was to increase the purchasing power of the population and to stimulate the economy. One facet of the housing finance before the Great Depression was that lending consisted mostly of short-term loans and down payments were huge, usually about 50% of the home value. Mortgages were granted mostly by life insurers, commercial banks, or savings and loan associations. There was no housing finance market, so rates varied a lot in different parts of the country. When the Great Depression happened, it was estimated that about 20 to 25% home mortgages was in default. Fannie Mae, which was established in 1938, was a government agency with a purpose of buying mortgages from lenders so they could free up more funds and make more mortgages. Business model of the company was pretty simple. Borrow money at cheap, variable interest rates, buy mortgages with fixed rates at specific percent, and pocket the difference. Let me give you an example. They would borrow 4%, use this money to buy fixed rate mortgage, which would pay, let's say, 5%. The difference would be profit before other expenses. But the difference could be even bigger. Lynch has bought first position in Fannie Mae in 1977, but he has sold as he was expecting increasing interest rates, which would crush the profits. And this is what happened basically in 1981. The variable rate was so high that the company wasn't making any money. But the example I gave you earlier with the rates and imaginary numbers was just to make a point. But if we use real numbers from 1981, when Fannie Mae bought some mortgages in mid-70s, they would be paying around 8 to 10% fixed interest. But unfortunately for the company, 1980s was the time when interest rates in USA was at the highest level. Mm, It was an aftermath of energy crisis and rising prices. This was the time when Paul Walker was motivated to slash down the inflation. It's interesting period from economy and stock market point of view, but that's too much to talk basically today. When interest rates rise, so did the cost of borrowing for Fannie Mae. It is a good importance of it is a good illustration of importance of return on capital employed, which should be higher than the cost of capital. It illustrates what Terry Smith has said, and we covered the example in one of previous videos. You simply cannot make money borrowing at 18% and being paid only 8 to 10%. This had negative effects on the company, and stock plummeted from $9 in 1974 to $2 in 1981. In 1982, big change occurs for the company with the guy named David Maxwell. He had an idea to reorganize the company in a manner that would enable possibility to offset the biggest risks, which was change in interest rates. He wanted the company to sell MBSs, name that now might have very negative connotations, but back then this sort of financial product was in early steps of its development. Industry was just getting started. But what really a MBS is? In this new business model, Fannie Mae would be buying mortgages. However, now they would bundle them together and resell to banks, insurance companies, or other entities wanting to invest in mortgages. And in that process, they were gaining the hefty fee for that. Maxwell did not invent this idea. This is what Freddie Mac was doing, which was another company created by the government that went public in the 1970s. This is worth noting if you want to understand better Lynch's investing picks. He did not gamble into this new idea that the company started. He saw an analogy between another company doing it and what management at Fannie Mae was trying to do. Let's put things that happened with Fannie Mae during Lynch's career into the timeline. He has started the position in 1977, but he was expecting higher interest rates, so he closed the position. And he was right, because in 1981 the company crashed. 1 year later, big change started to happen, and that was what got Lynch interested. He called the company in 1983 to inquire more about it. The company still had a portfolio of $60 billion consisted of mortgages with fixed interest rates. The average they were yielding was 9.25%. However, the cost of debt was 11.87%. One does not have to be a math wizard to realize that this portfolio wasn't making any profit. However, there were signs of light at the end of the tunnel because Lynch noticed how small the company's overhead expenses was. He compared it to the banks that had 2 to 3% overhead, while Fannie Mae was facing only 0.2%, so 10 times lower. Lynch even makes a remark that FM had 1,400 employees, which was probably about number of Bank of America's branches. Another strength of the company was in its quasi-governmental status, which enabled it to borrow at cheaper rates than any bank. Nevertheless, the restructuring seemed to work, as after 8 quarters of losses, the company had its first profitable quarter. However, the stock didn't move anywhere. So Lynch bought again in 1984, and in this year he increased his position to 0.37% of his assets. Therefore, not a huge commission to a stock. However, please note that sometimes he bought small number of shares as kind of a waiting list just to tune in later. Also, this was a year in which Fannie Mae decided to switch their borrowing from variable interest rates to fixed rates. They would simply issue bonds with fixed rates. In doing so, they penalized their short-term earnings, however, making company less vulnerable to swing in interest rates. So you can see that the gap would be smaller in this new model. However, the gap would be pretty much independent from interest rates. In 1985, we could safely say that Fannie Mae had two engines of growth: fixed income mortgages and MBSs. Fixed income has become less vulnerable to interest rates, although less lucrative in a period of low interest rates. It was less vulnerable to catastrophe that happened back in 1981. This was also a year that a lot of defaults happened in Texas, and people were leaving their homes. FM owned a lot of those mortgages, and fear about that part of portfolio crept in. But this was actually benefiting the company, as a lot of competition could not survive and competitors thinned out. Peter Lynch realized how fast the MBS industry was developing. He made a prediction that Fannie Mae could grow their MBS portfolio to stunning $100 billion. And with only 1% yield, they would make $1 billion profit on this portfolio. Remember that their overhead was minuscule in comparison to banks. so he assumed that the company could make $7 per share in closest couple years. With $7 per share price, that gave him PE of 1. This is just crazy. In 1986, that was a year where Fannie Mae got rid of another part of its old portfolio. MBSs were becoming more and more substantial for the company and market was booming. In 1987, Texas crisis got worse and a lot more defaults happened. Fannie Mae has become biggest real estate mogul just because of defaults. The company had to allocate a lot of resources in order to manage foreclosures and get rid of its new portfolio of real estates. This didn't worry Lynch much as he was in for the MBS business, not old fixed rate mortgages. His position at the time was between 2 and 2.3% of total assets. When describing events that took place in 1988, he called this sell the house, the boat, the cars, and the barbecue and put the money into this sort of buy. He increased the position to 3%. Also in this year, new changes happened in accounting rules and fees were booked in the period as they were received. So one quarter they could book $100 million of earnings, next quarter that would drop to 10 million earnings. That would scare out investors and cause stock to fall. He also notes that in 1989 Warren Buffett owned 2.2 million shares and as he respected him, I guess it's reinforced his conviction in Fannie Mae. This was a year where Fannie Mae earned $400 million in fees from MBSs worth over $225 billion. Lynch was right in assessing that MBSs would be a huge thing. Fannie Mae has become a fast grower with earnings growing at 15 to 20% a year. It's an example of how companies move from one category to another. You can get a fast grower from a turnaround and actually market might not notice that for a long time. In 1990, Fannie Mae has been hit deeply by USA getting involved in Gulf War. Because there was a panic about real estate depression, but actually the real estate depression was only for so-called fat cat houses. And Leach also noticed that Fannie Mae didn't write any mortgage for houses above $200,000. They averaged around $90,000. But that's not how investors felt, and stock fell from 42 to $24, but then quickly rose again to 38. That was quite a roller coaster for Peter Lynch. 1 year later, he left Magellan, but Fannie Mae had become a number one holding and its price went up to $60. This stock was turned around at $2 a share in 1981 and sold for $60 in 1991, which gives us roughly 40.5% annual rate of return. A hefty profit, I would say, but imagine you got scared in 1990 and sold at $24. Just 1 year before 1991, you still would get 30%. Let's recap what we have learned today from this wonderful investor. First of all, he made hefty profit on Fannie Mae, but he started learning about the company in 1977 and he retired in 1991. Through all those years, he tracked company's progress. He looked to competition in assessing competitive advantage of Fannie Mae, and that's how he realized that FM overhead was tiny. Another important thing is to get into understanding of the problem that everyone seems to be scared of. A lot of investors predicted correctly that there was depression incoming for real estate, but only for expensive trophy houses. Lynch knew Fannie Mae well enough to notice that this won't be a problem for the company. Look how many things have happened in the period we analyze. Energy crisis of 70s, high inflation, skyrocketing interest rates, Texas real estate crisis, Gulf War. It hasn't been that optimistic and filled with flowers and joy. I hope you learned something new from today. Thanks for watching and stay tuned for the next videos.